Outside of an individual retirement plan, a person should consider contributing to an employer-sponsored plan, as this is a great option to defer a larger amount of income and potentially getting matching contributions from the employers. There are several types of retirement plan that employers can offer. Let's take a look at them. Simplified Employee Pension Plan is a retirement plan that can be set up by employers or for the self-employed, and all contributions are made by the employers or owners. The attractive feature of this plan is that it is easy to set up and does not have the high cost to manage like other retirement plans. Contribution is only required if the employees have worked for at least 3 years, are 21 years of age, and have a minimum of $650 in compensation. If an employer opens a SEP, they cannot have any other type of retirement plan except for another SEP. Contribution into this plan is strictly done by the employer and up to 25% of the employee's gross income or an annual maximum amount. In 2022, this amount is $61,000, and employee that makes $305,000 will not qualify for this plan. Contribution is not mandatory, and the employer gets to choose the percentage of contribution or none at all. Whichever percentage the employer chooses to make, this percentage is applicable to all employees. Since the employers are the ones that make the contribution, the employer gets to take the tax deduction. In addition, when money is withdrawn, the total amount will be taxable since a full tax deduction was taken. When an individual works for an employer that offers this plan, it is definitely a perk, as the contribution is immediately vested and completely made by the employer. To clarify, vested means immediately available to the employee. Though withdrawal rule is similar to that of the individual IRA account, must be over the age of 59 and a half, with some exception as mentioned in the traditional IRA video. A SEP plan can be set up at a bank or investment and financial institutions, and employees have to be notified that the plan is available. Each eligible employee will have their own account and get to decide on their investment product based on what is made available by the employer. Savings Incentive Match Plan for Employee is a simplified retirement plan that looks similar to a 401k plan, but less costly to implement and simpler to manage. The biggest difference between a simple versus a 401k plan is the mandatory contribution required under the simple plan, though the maximum contribution allowed for the employees are less than the 401k plan. In 2022, the maximum contribution allowed for employee under 50 years old is $14,000, and for those over the age of 50, the amount is an additional $3,000 or a total of $17,000. For the employer's mandatory match, there are two options. The employer can provide up to 3% of the employee's pay, not limited by an annual compensation limit, or make non-elective contribution equals to 2% of the employee's compensation based on the maximum salary of $305,000. Just to clarify, non-elective means regardless of whether the employee contribute or not, the employer will have to make the contribution. The requirements for eligibility to participate in a simple IRA is simple. The employee must make at least $5,000 in compensation during any 2 preceding calendar years and expect to earn at least that much during the calendar year when they are participating. The IRS does allow employers to offer these accounts to employees who don't meet these standards. Just like the SEP plan, simple plans are immediately vested, and the choice in the product an individual can choose to invest their money in is dependent on what is offered by the institution that the employer decides to do business with. Withdrawal rules are similar to that of the traditional IRA. In addition, if money is withdrawn within the first 2 years of contribution under a non-qualified situation, an additional 15% penalty is added to the 10% traditional IRA penalty. IK, Individual 401k Plan, or otherwise known as Solo 401k. As a sole proprietor, there's a retirement plan similar to a 401k plan without the complicated filing and cost called Individual 401k or IK, and otherwise known as a Solo 401k. This is specifically designed for a sole proprietor without employees, or in some cases their spouse, if they participate in the business operation. What is attractive about this plan is it allows an individual to put away a larger amount of contributions as both the employer and the employee. In 2022, the maximum contribution on the employee side is $20,500 if an individual is under 50 years old and $27,000 if they are over 50 years old. As an employer, the company can contribute up to 25% of the employee's wage, up to a maximum of $40,500. So you can see an individual can put away a substantial amount as a sole proprietor. A few other attractive features about an IK is that the plan does allow an individual to borrow the lesser of 50% of the plan value or $50,000 and have up to 5 years to pay back unless it is used to pay for the primary residence, which would allow 30 years for payment to be made back to the plan. There are interests that will be charged to the borrower from the plan, but it is a flexible option that can be attractive for the contributor. Another attractive feature is the ability to contribute to the plan as a traditional IRA or a Roth IRA. Either way, the three tax advantage options, tax deductible, tax deferred, and tax-free, are made available for the choosing. Since it is a plan for the sole proprietor, the individual also have the ability to decide on his own how his investment will be managed and can be opened at any financial institution or be self-directed. Most commonly known and offered by many organizations, 401k is an employer-sponsored plan allowing employees to put money away tax-deferred for their retirement. The employer would make available a selection of investment options, and the employee can choose to invest in the portfolio of what is made available. Under a 401k plan, an employer can make available both Roth and traditional 401k, which allows an employee to choose whether they want to take a tax deduction or tax-free option. Just like all tax-qualified plans, there is a maximum amount that can be contributed, and this limit can be changed each year. For 2022, for employees under the age of 50, the limit is $20,500, while those that are over the age of 50 can contribute an additional $6,500. That said, with employer contributions, those under 50 years of age cannot exceed $61,000 and over 50 can not exceed $67,500. Under the traditional 401k plan, an employer may offer a certain amount of matching contributions, but it is not mandatory. The most popular calculation uses a dollar-for-dollar contribution match up to 6% of the employee's salary or 50 cents on the dollar. For example, if your staff's total salaries are $500,000, a dollar-for-dollar match would be $30,000 if every employee maxed out all of their contribution. A factor that's important to mention is that 401k can have longer vesting periods, varying from immediate to as long as 7 years, though 3 to 5 years is most commonly seen. What this means is if an employee leaves employment prior to this time, they may not be able to receive all of their employer's contribution amount. Of course, the contribution made through the individual's payroll is theirs and they can take it in full. This plan is very similar to a 401k plan, but is designed for specific types of entities and occupations. 403b is for employees of public schools and tax-exempt organizations. Some differences are 403b tend to have less investment options but shorter vesting period. 401k plans have to meet minimum standards set by ERISA guidelines, while 403b plans do not. Due to these looser guidelines, it is less costly to administer 403b plan than it is to manage a 401k plan. 457 is a non-qualified tax advantage program that is split into two types. 457b, which is most common and is offered to state and local government employees. 457f is a plan offered to highly compensated government and select non-government employees. Maximum contribution is similar to all the other employer-sponsored programs, including catch-up contributions, but unique in that it offers a double limit catch-up when an individual is near retirement age if they did not contribute in the earlier years. For example, an employee that is 3 years within the retirement age can contribute up to $41,000 in 2022 to catch up for what they've missed in the earlier years. The other unique feature about 457 plan is that early withdrawal will not result in a 10% penalty like the other retirement plans. That said, the maximum contribution, whether contributed by the employee or matched by the employer, cannot be more than the annual maximum, which for 2022 is a total of $20,500. Both 403 and 457 plan offers a traditional and Roth contribution option. A few more things to note. Though there is a limit to how much contributions can be made annually, the contribution can only be up to 100% of your wage earned. For example, if the limit is $20,500 for 2022, but an individual only earned $15,000, then the maximum they can contribute is $15,000. For plans that offer both Roth and traditional investment options, an individual can choose one or the other or both, but the total amount of contributions cannot exceed the annual maximum. This is also true for people who have multiple jobs with retirement plans offered by each of their employers. Just like the individual plans, employer-sponsored retirement plan does have a mandatory distribution requirement. For those born before July 1st, 2019, the age is 70 and a half, while those born after this date do not have to take distribution until the age of 72. Finally, when an individual leaves their employer, they generally have one of four options. If the plan allows, an individual can leave their plan with the employer. If this is a good plan with a good advisor, it isn't a bad option, especially when all fees have already been paid. However, if the plan is not well managed or support is poor, it may make sense for the individual to move the investment into other options for better care. Transfer the assets to a new employer's plan. This is always an option, though the individual may find their asset locked into a different defined plan and would lose the flexibility of investment options. They can also take a lump sum distribution. When choosing this option, the individual needs to keep in mind that there may be tax consequences, and if taken before the age of 59 and a half, there may also be penalties. In these cases, it would be best to consult a tax professional to make sure taking a distribution is a sound decision. Finally, you can roll over your assets into an individual retirement account. This is an option that will allow the individual to take control of their account and investments. However, once rolled into their individual IRA, options such as borrowing from the account may not be available. That's it. That covers all of the retirement plan that can be made available to an employer and employee. When considering a position with a company, an individual should consider these benefits as it can add to the total compensation package. In addition, paying tax now or paying tax later may make a difference in an individual's income tax bracket and their final take-home pay.